Welcome, friends. This is our India's Knowledge Series video number 15, and today we will be discussing India's 27 separate financial statements. You may be wondering why we should discuss about separate financial statement where there is elaborate guidance which has been provided by Schedule 3 to the Companies Act 2013. In fact, the preparation of separate financial statement was part of the erstwhile Ind AS 27 along with the consolidated financial statement. The earlier name of the standard is IAS 27. When it was IAS 27 erstwhile, it was called Consolidated and Separate Financial Statement. After consolidated financial statement has been separately included under Ind AS 110 consolidated financial statement. Now, Ind AS 27 or the revised IAS 27, which is equivalent to Ind AS 27, is only talking about the separate financial statement. What are all the circumstances it has to be prepared, and what are all the requirement for preparing the separate financial statement? That's what this particular standard is mentioning. In simple terms, this standard is a very simple standard with minimum prescription because uh, majority of the accounting treatment will be in accordance with the respective accounting standards. And when it comes to the complexity of preparing a consolidated financial statement, it is not within this standard, it goes into Ind AS 110. Similarly, when we are trying to account for investment in associates and joint ventures, where we talk about significant influence or when we talk about the joint control along with another entity, that accounting treatment is in a different standard, Ind AS 28. And to that extent, this standard is a very simple standard for understanding. And as part of our learning curve, I think that we should not omit this particular standard as well. That is the reason behind preparing a video on Ind AS 27 as well, even though it is a simple standard to understand. Friends, before we go into the standard, it is my duty to thank each one of you for sending valuable inputs, suggestions, and comments, and also sending your queries on various standards which has been uploaded so far. And some of you are more enthusiastic and sending queries on even standards which is not yet covered as part of our Ind AS knowledge series videos. I will be thankful for those people as well because those queries will be part of the subsequent videos where I will take them as case studies for the benefit of the entire audience. And uh, one of the important question which comes to me is regularly, I have seen only the current video. Can I have the link of the previous video? To that extent possible, I am sending the link through WhatsApp messages to those people who are requesting for it. But my understanding is that the better way of you getting hold of all the videos which has been uploaded as part of our India's knowledge series is to subscribe to our YouTube channel. If you are subscribing to our YouTube channel, I think that the moment I upload any new video, automatically the subscribers will get a notification and you will never miss any of our videos. So accordingly, whenever you are sharing to any of your friends, you also ask them to be a subscriber so that from the next video onwards, they will get an automatic notification. With that, let us move on to the standard and how we have structured our entire discussion for this particular standard. When I said it's a very simple standard, if we adopt a structured approach to understand the guidance given in this standard for the preparation and presentation of a separate financial statement, it will be useful. That's the reason why we are again structuring what is the objective and scope of this standard. What are all the types of financial statement Ind AS is talking about? Whether it is only talking about a separate financial statement, or it is also talking about something else. We will look into that. So, how a separate financial statement should be prepared and presented, we will have a discussion. And there is a small conflict between India's 27 and Companies Act 2013, because the way in which Indian regulation is operating is little different than the countries who are adopting IFRS, where consolidated financial statement is a mandatory requirement. In addition to the consolidated financial statement, separate financial statements are also prepared and presented. Whereas in India, we have a different requirement as per the Companies Act. So we will get into the requirement of Companies Act 2013, and that is our legal requirement as far as the preparation and presentation of financial statement by an entity. We will look into that little later. And what happens is, an investment which has been made in a subsidiary, associate, or joint venture might have been classified for the purposes of measurement according to the options given in this particular standard. And subsequently, if the entity remeasures those investments because of some reclassification which is happening, what is the accounting treatment? Both for classification and reclassification, we will see. And another possibility could be the group itself is reorganizing. For example, a group has a parent and it has a subsidiary, and it also has associates and joint venture. When the group is restructured, when a parent company is no more a parent company, and a parent company doesn't have a subsidiary no more, the parent company's investment is now either associate or just a financial statement. How it has to be accounted for in case of such reorganization of the group structure is what we will look into. And we will also see what are all the major disclosures required as per this standard, and also what is the significant difference between Ind AS and AS. Because AS 21 is talking about consolidated financial statement. Whether we have a separate standard for preparing and presenting separate financial statement, the answer is no. Indian GAAP does not have a separate standard for the preparation and presentation of a separate financial statement. It is covered by Companies Act 2013. Only for consolidated financial statement, it gives certain guidances. When an entity should consolidate, when the entity need not consolidate, it gives a guidance. So we will see what is the difference between Ind AS and AS in this particular respect. So what is the objective? The objective is to prescribe what is the accounting treatment and disclosure requirement when an entity prepares a separate financial statement. So anyway, I'm preparing a separate financial statement. Why I should have a guidance? The guidance is how you have to account and disclosure the investments made in the subsidiaries, joint ventures, and associates when you prepare and present your separate financial statement. In simple terms, A Limited has investment of more than 60% in the company B Limited. It also invested, say, for example, 30% in C Limited, and it also has an investment in a joint venture D Limited. So when I prepare the standalone financial statement, all these items are classified only as an investment. When this investment is not an investment outside the group, and I have either control, joint control, or significant influence because the investment is made in subsidiary, joint venture, or associate, whether the category changes from investment to something else, if it is not changes, what is the way in which I have to deal with that? For example, if it is an investment outside subsidiary, associate, and joint venture, it is getting covered in Ind AS 109 financial instruments. Financial instruments gives an accounting treatment and measurement principles for those investments outside the group, outside associate, outside joint venture. That means we should have some sort of guidances, right, with respect to the accounting treatment and disclosure requirement when an entity has made an investment in its subsidiary or associate or joint venture. That is what this particular standard is prescribing, and it will be applied only for accounting of investment in subsidiaries, associate, and joint venture. So it is not applied for any other investments. So that is very, very important. It actually covers only the three limited investments. Here it says when this standard should be applied. It says when the entity elects to prepare a separate financial statement or the entity is required by law to present a separate financial statement. Interesting. Entity elects to present a separate financial statement. In Indian scenario, it is not possible because you don't have an option to decide only to present a consolidated financial statement. That's what we have said. There is a difference between Companies Act 2013 and your requirement as per Ind AS 27. In Companies Act 2013, an entity is required to prepare its separate financial statement and also has the responsibility to prepare a consolidated financial statement according to section 129 subsection 3 of the Companies Act 2013. And accordingly, preparation of the separate financial statement is a mandatory requirement under the Companies Act 2013. That means here I don't have an option. Why we felt that there is no significant difference between this and Companies Act 2013? Because it says that it is required by law to present a separate financial statement. In Indian scenario, it is required to present a separate financial statement under the Companies Act. So law prescribes that it has to be prepared, and that is the reason why we are believing that Ind AS 27 is not having any divergence with Companies Act 2013. But only thing is where it has a divergence is it doesn't have an option to prepare a separate financial statement. It is required by law to prepare a separate financial statement. When you prepare a separate financial statement in accordance with the requirement of Companies Act 2013, you should follow the requirement of Ind AS 27 to that extent that entity has investment in subsidiaries, joint ventures, and associates. Okay, so that is what we are supposed to talk about. The accounting treatment and disclosure requirement when Companies Act 2013 requires an entity to prepare a separate financial statement, how those investments will be recognized and disclosed in that particular financial statement is the coverage of this standard. It is very simple for your understanding, if I am not wrong, is that when you prepare a separate financial statement in accordance with the Companies Act 2013, as per Schedule 3 to the Companies Act 2013, because it's an Ind AS company, you are preparing under Division 2 of Schedule 3 to the Companies Act 2013, how your investments in subsidiaries, joint ventures, and associates has to be measured and included in the separate financial statement. And what is the related disclosures in respect of those investment in subsidiaries, associates, and joint venture is what this standard is covering all about. Very, very simple for us to understand. This is what we are talking about, the divergence, because this particular paragraph may not be whole good if you are literally trying to interpret this particular paragraph. Because para 6 of Ind AS 27 says an entity when presents separate financial statement, it is presented in addition to the consolidated financial statement. That's what the wording used. Separate financial statements are presented in addition to the consolidated financial statement. Whereas in Indian scenario, because of Companies Act 2013, separate financial statement is a mandatory requirement. And in addition to the separate financial statement, a consolidated financial statement is also prepared and presented by an entity which has one or more subsidiaries as per section 129 subsection 3 of the Companies Act 2013. Interestingly, in respect of that particular section, it says the term subsidiaries includes associate and joint venture for the purposes of this particular section. That means even if I do not have a subsidiary, I only have an investment in associate, I have an investment in a joint venture, then the Companies Act 2013 prevail over this particular paragraph uh, which says separate financial statement is in addition to the consolidated financial statement. The position in Companies Act is little different. Consolidated financial statement is in addition to the separate financial statement. I think you will understand what is the divergence between this. So don't go by literal interpretation of this particular paragraph, because the other paragraph says when an entity is required by law under Companies Act 2013, you are required to prepare a separate financial statement, and that is prepared along with the consolidated financial statement according to section 129 subsection 3 read with Ind AS 110. So that is the way in which you have to interpret this particular paragraph. So not only Companies Act 2013, even SEBI listing and other disclosure requirements regulations also requires an entity to mandatorily present a standalone financial statement. So standalone financial statement is nothing but separate financial statement, and that is prepared, and then you prepare a consolidated financial statement. That is a requirement here. In IFRS scenario, standalone financial statement, even though prepared, is not actually required to be filed with the regulators. Only the consolidated financial statements are filed with the regulator, unless the specific law in respect of those countries requires both to be filed, like in Indian scenario. In Indian scenario, the standalone financial statement is used for every regulatory purposes, and consolidation is additional requirement. That's the only thing which you have to keep it in your mind. Now, we have to understand what is the types of financial statement which is dealt with by this particular standard. The standard says what the first type is a separate financial statement, or SFS. Maybe we will use this abbreviation throughout the discussion. When the SFS is prepared, what is meant by SFS? It is a financial statement of an investor on a standalone basis. So it's only a standalone financial statement of the investor for its assets and liabilities, income and expenditure arising out of those assets and liabilities, and the business of the investor. In that particular SFS, where the investor also has an investment in subsidiary, joint venture, or associate, the accounting treatment says it has to be accounted in accordance with Ind AS 27. Ind AS 27 says those investments has to be accounted either at cost or in accordance with Ind AS 109. Ind AS 109 is on financial instrument. We'll look into that a little later. So if a financial statement of the investor where there is an investment of subsidiary, joint venture, associates are accounted for at cost or in accordance with Ind AS 109, that is considered as a separate financial statement. It leaves us a question. Suppose I don't have any investment in subsidiary, joint venture, and associate. What happens to that separate financial statement? Is it a separate financial statement or not? I will put here one point for you to have it in your mind. The standard tries to differentiate a standalone financial statement from a separate financial statement. Standalone financial statement is a statement which has been prepared by an entity which doesn't have any investment. That is what it tries to say. It uses the word individual financial statement in certain places, or standalone financial statement in a certain situations. But as far as Indian scenario is concerned, your standalone financial statement or separate financial statements will be same for a simple reason. You don't have a concept of a financial statement made by an entity which doesn't have investment in subsidiary, joint venture, or associate. So for Indian purposes, the standalone financial statement will also be considered as a separate financial statement. But in IFRS scenario, a standalone financial statement means a financial statement prepared by an entity which doesn't have an investment in associate, subsidiary, or joint venture. Separate financial statement refers to the financial statement in which there is an investment in subsidiary, associate, or joint venture. So that is what the difference which you have to understand. So for our literal understanding, the standalone financial statement and separate financial statement can be considered as a same financial statement. But the accounting treatment covered by this separate financial statement will be applied even a standalone financial statement is prepared by an Indian entity which has investment in subsidiary, associate, and joint venture. So for us, it's a standalone financial statement, and we will apply the principles given with respect to recognition and measurement of investment as per Ind AS 27. Okay. Otherwise, we will simply go to Ind AS 109. To avoid that, it gives some guidance of how the investment in subsidiaries, associate, and joint venture to be accounted for. Having explained what is a separate financial statement and what is a standalone financial statement, let us understand what do you mean by consolidated financial statement or CFS. This is the financial statement of the group. That means the investor as a parent company consolidates its investment in subsidiaries, joint ventures, and associates and make one single consolidated financial statement showing the entire assets and liabilities, the entire operations or financial performance of the entity, and the statement of cash flows of the group, so not entity, group as a whole is what we call it as a consolidated financial statement. So it is nothing but the parent and its subsidiaries. Subsidiaries includes your associates and joint ventures for Indian purposes. But in normal scenarios, when you are talking about a group considers only only the parent and the subsidiaries. But by definition of section 129 subsection 3, in Indian scenarios, the term subsidiary includes associates and joint ventures as well. But how to account for associate and joint ventures is not covered by Ind AS 27, even in Indian situation, because there is a specific standard called Ind AS 28, which accounts for or defines the accounting treatment with respect to investment in associate and joint ventures. That's the reason why we are saying consolidated financial statement. Ind AS 110 covers only accounting for consolidation of subsidiaries, because Ind AS 111 as well as Ind AS 28 is allowing you to recognize the investments made in associate and joint ventures, how it has to be accounted for. We will look into this consolidation process a little later when I'm discussing Ind AS 110, and you will understand what we are talking about consolidation. Here also we will discuss little bit on consolidation, but not at length. We will only have the principles, but we will discuss that in Ind AS 28 when we consolidate the investments made in associate and joint venture. To understand this, let us have some quick questions. An entity does not have a subsidiary, but only has an investment in associate and joint venture. Whether Ind AS 27 will apply? Yes, it will apply, because if you see the separate financial statement says it is a financial statement of the investor and gives the guidance for recognizing and measuring the investments made in subsidiaries, joint ventures, and associates. And accordingly, still Ind AS 27 will cover, or separate financial statement will be considered. What happens if the entity does not have a separate, does not have any investment in subsidiary, associate, and joint venture? So in that case, it doesn't have an investment, and accordingly the entity cannot be considered as an investor. When the entity cannot be considered as an investor, Ind AS 27 is not applicable. So then what happens? What is the guidance which has been given? It prepares a standalone financial statement. The standalone financial statement, because it's mandatory to be prepared, it should be preparing, and that will be guided by the Schedule 3, Division 2 of the Companies Act 2013. That is what you have to understand. And when there is no investment at all held by the entity, still we will prepare the standalone financial statement in accordance with the Companies Act 2013. Now, when an entity has to prepare a separate financial statement, or when an entity prepares a separate financial statement, whether the investment which the entity has, is it in a subsidiary? So that means I'm a parent company, I made an investment in a subsidiary. If it is an investment in subsidiary, if I answer yes, the next important question is whether the entity has opted for exemption given in Ind AS 110 for consolidation, because Ind AS 110 consolidated financial statement gives an exemption for intermediate holding company. If I'm not wrong, I think that we have discussed what is intermediate holding company when we were discussing about the related party relationship. So let us recap our understanding. Suppose A is the parent company and has invested in B Limited, and B Limited in turn has invested in C Limited and D Limited. What happens in the structure? A Limited is also a holding company and B Limited is also a holding company with respect to C and D. But A Limited is the ultimate parent company or ultimate holding company, and B Limited is an intermediate parent company or intermediate holding company, whatever term which you wanted to use. But normally parent company is the word which has been used throughout the Ind AS. So if it is an intermediate parent company, Ind AS 110 gives an exemption from preparing the consolidated financial statement. Let us come back to our example. A has a subsidiary B Limited, and in turn B Limited has made an investment in 200% subsidiaries C Limited and D Limited. So what happens? Section 129 subsection 3 of the Companies Act requires a consolidated financial statement should be prepared if an entity has an investment in one or more subsidiaries. Similarly, 110 also says, Ind AS 110 also says, if an entity has investment in one or more subsidiaries, it should prepare a consolidated financial statement. So in this scenario, what happens? A has an investment in B Limited, which is a subsidiary, and also has two step-down subsidiaries, C Limited and D Limited. So naturally, according to the provisions of section 129 subsection 3 as well as Ind AS 110, entity A should prepare a consolidated financial statement. B Limited also has two subsidiaries. That means B Limited is also a holding company and it has an investment in one or more subsidiaries. That means B Limited should also prepare a consolidated financial statement as per Ind AS 110 as well as section 129 subsection 3 of the Companies Act. Now the question is, who are the ultimate persons holding interest in all the three companies, B Limited, C Limited, D Limited? The owners of A Limited are the shareholders of A Limited. And accordingly, is it necessary for preparing two consolidated financial statements? So Ind AS 110 also felt that it is not required. Companies Act 2013 also felt that it is not required. It's a dual exercise or duplicate exercise. So it said that if certain conditions have been fulfilled, an entity is not required to prepare a consolidated financial statement even if it has investment in a subsidiary. What is the requirement? If the entity is an intermediate parent company, in our case B is an intermediate parent company, and it has been approved or permitted not to prepare a consolidated financial statement by the shareholders of the parent company or the ultimate parent company, as the case may be. In our case, A Limited shareholders have permitted B Limited not to prepare consolidated financial statement. Fine. First condition satisfied. Second condition says the intermediate parent company, in our example B Limited, should not be a listed entity or in the process of listing its securities. So it should not be a listed company, as well as it should not be in the process of listing its securities. So when we are using the word securities, you know pretty well, right from our discussion on the roadmap for Ind AS. The roadmap makes it very clear that when you are talking about listing in India or abroad, and when you are talking about securities, securities includes both equity shares or debt instrument. Debt instrument may also include redeemable preference shares as far as Ind AS is concerned. So when it is neither a listed entity nor a proposed listed entity, second condition is also satisfied. The third condition says the parent company or the ultimate parent company, in our case the parent company is A Limited, prepares consolidated financial statement which is available for public use. What does it mean? B Limited is exempted only if A Limited prepares a consolidated financial statement. Then only the third condition is satisfied. So all the three conditions should be satisfied. Even if one condition is not satisfied, that exemption under section 110 is not available for an entity having a subsidiary. And as per section 129 subsection 3, this exemption is available only if the entity does not have a subsidiary or associate and a joint venture. That means even if it has a subsidiary or associate or joint venture, it has to look into those scenarios, whether the intermediate subsidiary has associate and joint venture. That is also to be referred to. So if all the three conditions have been satisfied, I am repeating again that the ultimate parent company permits the intermediate parent company not to prepare a consolidated financial statement. Second condition, the intermediate parent company is neither a listed company nor a proposed listed company. Third condition, the ultimate parent company or the parent company prepares consolidated financial statement which is available for public use. If all the three conditions are satisfied, the entity, even if it has an investment in subsidiary, associate, and joint venture, need not prepare a consolidated financial statement. If such option has been opted by the entity not to prepare consolidated financial statement, it will only prepare a separate financial statement. In the separate financial statement, suppose if I'm saying no, the exemption is not there, it will prepare consolidated financial statement on a mandatory basis along with a standalone financial statement. Okay. Now, suppose if I'm saying no, the investment is not in a subsidiary, is the investment is an associate or joint venture. If I'm saying yes, similar exemption is available under Ind AS 28 because Ind AS 110 deals with subsidiary relationship. So that gives an exemption based on the three conditions. Similarly, Ind AS 28 gives an exemption in respect of investment made in associate and joint venture not to prepare consolidated financial statement by an intermediate parent company. Okay. So if that option is not exercised, it will prepare a consolidated financial statement. Otherwise, it will only prepare a separate financial statement and investments have been measured as per Ind AS 28. Interestingly, I am using the word investments will be measured using Ind AS 28 in a separate financial statement. We'll see what does it mean. Whereas a similar guidance is also given in Ind AS 27 how to measure the investments. So for the time being, we will discuss about the measurement principles with respect to Ind AS 27. Okay. Suppose if I say if the investment is neither investment in subsidiary or investment in associate or investment in a joint venture, what does investment mean? It is a simple financial asset. The moment it is a simple financial asset, this is not covered either by Ind AS 27 or Ind AS 28. It will get covered by Ind AS 109. The principles of measurement will go to Ind AS 20, goes out of Ind AS 27 and Ind AS 28 and goes to Ind AS 109. So you have to be very clear. If it is a subsidiary and I have the measurement principles and consolidation principle as per Ind AS 110, if I have investment in other than subsidiary, which is joint venture or associate, I will use the principles given in Ind AS 28 read with Ind AS 111. When it is neither an investment in a subsidiary nor an investment in associate and joint ventures, then it goes to simple financial asset, and to that extent Ind AS 109 should be applied for. So you are clear on what is the accounting treatment for various types of investments. How to prepare a separate financial statement, or when to prepare a separate financial statement? It says that separate financial statement shall be prepared in accordance with all applicable Ind AS. So on this basis only I am saying, even if you prepare standalone financial statement in accordance with the Companies Act, I'm trying to say that I'm still complying with the Ind AS 27. We can have that as this, but the only thing is here investment may not be there in a subsidiary or associate or joint venture. That's the only difference which we will have. In the separate financial statement, investment in subsidiaries, associates and joint ventures has to be accounted for. So what normally I do for investment? I will consider investments at cost if the conditions are satisfied as per Ind AS 109, or I will consider that investment as fair value through OCI or fair value through P&L. These are all the three normal principles of measuring the investments in subsidiaries, associates, and any investment. But the specific provision comes in Ind AS 27 if the investment has been made in a subsidiary or a joint venture or an associate, you will be accounting or measuring that particular investment as per Ind AS 27, and you will not go to Ind AS 109 except when this standard allows you to do it. What the standard says, you have to measure this particular investment at cost. That is a normal option or normal prescription which has been given. It also gives one more option, interestingly, to say that this investment can also be measured at the principles given in Ind AS 109. If you see, majority of the published accounts which has been prepared in accordance with Ind AS 27, a standalone financial statement of a listed entity which is publicly available, you can download and see the annual reports of many published companies. You will see that majority of the investments made by those entities are classified into financial assets, and within financial assets they classify fair value through P&L, or maybe at cost, fair value through P&L, and fair value through other comprehensive income, OCI. And below that you will see investment in subsidiaries, associate and joint venture at cost. So they have classified the investment itself into two categories. One, what is covered under Ind AS 109, that is investment made other than in subsidiaries, other than in associate, other than in joint venture. When it comes to investment in associate, subsidiaries and joint venture, that investments are covered by Ind AS 27, where you have to keep that as a separate category of investment. That category of investment shall be measured either at cost or at the option of the entity as per Ind AS 109. When it goes to Ind AS 109, you have to do fair value. When you are doing a fair value, you are allowed to have fair value through P&L or fair value through OCI, depending upon the facts and circumstances of the case. Because how the equity should be considered classification, there is a guidance given in 109. If the investment in the subsidiary, associate, and joint venture is an equity instrument, if the entity has opted for fair value through OCI, it can fair value through OCI. Otherwise, automatically it goes to fair value through P&L. So if the entity wanted to do an accounting as per Ind AS 109, it goes to fair value through OCI or fair value through P&L, even in respect of investment in subsidiaries, associate, and joint venture. Otherwise, it can simply ignore Ind AS 109 and go for a cost model approach with respect to presentation in the separate financial statement. Goes without saying, the moment you are using a cost model, you have to go for an impairment testing as well at each reporting period, so that the carrying amount of the investment should match to the recoverable amount. If there is a fall in the recoverable amount, you have to write down the investment for the impairment which has happened. So that goes without saying. Anything which has been accounted, any asset which has been accounted at cost, we should always measure that for any possible impairment adjustment. For example, when I'm saying property, plant, equipment, I'm testing for impairment as per Ind AS 36. If I'm talking about intangible assets, again I'm testing impairment as per Ind AS 36. When I'm having an investment in inventory, I'm testing it for net realizable value, any write down to be done according to Ind AS 2. When I have other financial assets like trade receivables or other than investments made in any of the subsidiaries, associate, and joint venture, I will be testing the impairment in accordance with 109. Similarly, here also I will test for impairment if I am holding it at cost in accordance with Ind AS 27. So whenever, it's a simple principle, when you are trying to understand any accounting standard or when you wanted to understand any Ind AS, if any asset has been recognized at cost, you should always consider whether the cost has to be returned down to its recoverable amount, because the value has come down. There is an impairment is there. So you have to always consider that as one of the accounting principle. Why I'm saying that is, sometimes in the presentation I may miss a point, talk about impairment, but you have to always consider this for every asset which is recognized at cost. Let us now take some examples for us to understand. Entity B prepares its separate financial statement. It wishes to apply equity instruments, equity method for its investment in associates and joint venture. Is it correct? Equity method of accounting. It wanted to apply for separate financial statement. But if you see, you can have only two methods, either at cost or in accordance with Ind AS 109. Other than this, no other measurement principles are permitted. Accordingly, what they wanted to apply is other than cost and other than Ind AS 109 treatment, so it is not possible. More interestingly, equity method is normally applied only when a consolidated financial statement is prepared. It cannot be applied for preparation of a separate financial statement. And equity method has been given in Ind AS 28, how the equity method will be applied. It's coming from Ind AS 28. We will discuss at that point of time. Classification and measurement of the investment. What it says is, it can voluntarily elect or required to measure its principal investments when it prepares a separate financial statement as per law. So in that case, it can do fair value through profit and loss account or in accordance with Ind AS 109. Suppose if the entity opted for fair valuing its investment in associates and joint ventures in accordance with Ind AS 109. What is the accounting treatment? If you have applied for fair value through P&L, not fair value through OCI, in that scenario, as per Ind AS 109, the same principle should also apply here. Here you cannot say I will do it as fair value through OCI, even though I wanted to have it for the purposes of on a voluntary basis, I have opted for fair value through P&L. Whatever is the classification which you have applied as per Ind AS 109, because you have an option to elect. The moment you have elected, that same thing should be applied here. You cannot have something because you have opted for it. Suppose if the investments, whatever investment I have made in accordance in a subsidiary or associate or joint venture, what I am supposed to do? Suppose if those investments have been classified as held for sale, that means they have included in a disposable group. What I have to do? For the time being, I will say that this has to be accounted for at cost in accordance with Ind AS 109. Sorry, 105. Ind AS 105 talks about non-current asset held for sale and discontinued operations. So the moment you are reclassifying a non-current asset, which is an investment, into held for sale, either separately or as part of the disposal group, then that non-current asset loses its characteristics to be covered in Ind AS 27 or financial instrument standard. So what it has to be stated, sorry, it loses its characteristics as per Ind AS 27. So what you have to do, you have to consider them as part of Ind AS 105. So Ind AS 105 says investment should be considered as per cost model. Suppose if these investments have been opted, that means I have two options now, Ind AS 27 cost model. Those cost model measured items will go to Ind AS 105. Suppose if I have applied the measurement principles in accordance with the Ind AS 109, it says don't change anything on that. So if it is fair valued, let it be the fair valued item. And every time you consider what is the adjustment to be done. It is not changed in such circumstances, which is accounted for as per Ind AS 109. Okay. On disposal, you recycle whatever balance available in your other comprehensive income also into the P&L account. If it is fair value through P&L, anyway you are going to take that into the P&L account. If it is cost, 105 will get impacted. If it is measured at fair value or as per Ind AS 109, that it will continue to be measured at the same principles. It will not change. What happens when there is a reclassification? What could happen? Previously, I have an investment in a subsidiary, but that investment is no more a subsidiary because I have lost the control over the subsidiary. So it could become a parent become just an investment entity. I have made because I lost the control. It is no more my subsidiary. The investment is considered as a simple investment. Then I have to consider that as fair value through P&L because it's normally an equity instrument. And this fair value through P&L, when the reclassification happens, should go to the P&L account. Whatever difference in the original carrying amount minus its fair value at the time of change should go to my P&L account, including any portion which is in OCI. Why this is? If you recollect, we were discussing about investment in a foreign operation where there is a partial or a complete disposal. It is like a complete disposal where I have lost the control. So it is like a disposal of my investment in a subsidiary, and accordingly, I am not permitted to hold that as part of my OCI. So since it is fair valued through P&L, still I cannot consider that as part of OCI. It should go to my P&L account, including the accumulated balances kept in OCI, if any. So when the parent becomes just an investment company, it's a financial asset, and the financial asset is not allowing you to have the option of holding at cost or OCI. It should be fair valued through P&L, and the difference between the carrying amount and the fair value at the time of change in the nature of the investment should go to P&L account. Suppose I'm not an investment entity. That means what happens? This becomes a subsidiary. So previously I don't have a control. Now I got the control, and now I become a parent, or I become an associate or subsidiary. So in this case, since I am using the word parent, we will assume that The investment which was just a financial asset now becomes investment in the subsidiary. So what happens on the date on which the status changes, it falls under Ind AS 27. So previously it was recognized as per Ind AS 109. Now it falls into Ind AS 27. When it comes to Ind AS 27, the measurement allows you to have cost or as per Ind AS 109, assuming that the entity decided to opt for the cost, not for the fair value model. Ind AS 109 measurement. It doesn't want to use it. It is permitted to measure that investment in subsidiary where it loses the characteristics of just a financial asset and control has been established. What is the fair value of the subsidiary as the deemed cost? You have to take it as a deemed cost. So what happens? Because this results in an adjustment, the resultant adjustment will go to your P&L account, because at that time a financial asset is getting converted into an equity investment. So to that extent, it will also go to the P&L account. The difference between the original cost and the fair value, which is considered as a deemed cost, investment account will be debited and credit will go to the P&L account to that extent of the difference. Or at the option, it can continue to measure the investment in subsidiary as per 109. If it continues to measure it under 109, only thing which we have to see is that whether fair value to OCI is permitted and fair value through P&L only should be applied. Here it is possible, because only where there is a reclassification is happening, it says it's to be accounted at fair value through P&L. Otherwise, fair value through OCI is also possible based on the consideration given in classification as per Ind AS 109. So we have seen a case where parent loses the control and becomes financial asset. What is the accounting treatment? We have also seen a case where entity becomes the parent, and whatever previous investment which it has happens can also be coming under Ind AS 27, and the option of recognizing at cost is also permitted. The deemed cost is nothing but the fair value on the date of change of the status, or otherwise it can continue the existing principle of 109. Okay, we are clear on classification and measurement, and we are also clear on reclassification and measurement. Let's have some quick questions. So suppose if I get a dividend from a subsidiary or joint venture or an associate, when I have to recognize in the profit and loss account is an important question, right? Because whenever a dividend comes in, I'm recognizing the dividend. What it says is that dividend should be recognized only when the right to establish the dividend is covered. In fact, if I'm not wrong, there was a question in our YouTube channel. Somebody has asked the question, when dividend has been uh, given by a subsidiary or joint venture or associate, Ind AS 115 is not specifically talking about how it has to be accounted for. And similarly, any dividend, other than that also, it is not specifically talked about and what should be the accounting treatment. If the subsidiary or associate or a joint venture declares the dividend, but it is not approved by the shareholders, whether it is possible for me to recognize, going by the principles given in Ind AS 27, it is not possible to recognize up to the time the entity has the right to receive the dividend. That means the shareholders approve the dividend. You cannot just accrue the dividend as an asset when the investee has declared the dividend. Only when the right to receive has been established, you can do it. So for my friends who has asked that question about Ind AS 115 is silent on this, please go with the principles of Ind AS 27. The principle is no difference from what is the dividend in respect of any other case. Only when the right to receive the dividend has been established, you can have it. So this is what I have said. When you are posting questions, you need not post questions only on the standard which we have covered. That I'm trying to handle it by means of separate Q&A session. And if it is relating to any standard which we are supposed to cover, not yet covered, please do it. And if there is a connection with respect to the particular standard, I will take it at the appropriate time. So it will help for the understanding of the larger audience. Let's have one more item where it says Y Limited has acquired a company Z Limited with a stake of 100%, but it wanted to dispose it off within 8 months. How should the investment in Z Limited be treated in Y Limited? Sorry, actually, yeah, Y Limited is the company which is acquired, and in Y Limited financial statement, how the investment in Z Limited should be considered. When I took 100% investment, 100% stake in another entity, automatically parent and subsidiary relationship comes in, and to that extent, it falls under Ind AS 27. The moment it comes to Ind AS 27, I have two options: at cost or as per the measurement principles given in Ind AS 109. Both are available. But the additional fact which says that the acquisition itself or disposing the investment within next 8 months. So assuming that I'm classifying this investment as investment held for disposal, non-current assets held for disposal, and it goes into 105, we have said that it should not be consolidated using equity instrument, because either the measurement should be as per Ind AS 109, it is not a subsidiary because it is a non-current asset held for sale, and the principal will be either as financial asset or as per Ind AS 105, where it says it's a held for disposal. So accordingly, the principal will go into that, and no question of consolidation of this. When you are not consolidating a subsidiary because it's held for sale, a lot of disclosures are required as per Ind AS 110, read with Ind AS 112, disclosing the interest in other entities that comes into the picture. Okay, even if it is 105, non-current asset held for sale, a lot of disclosures are required to be done. But don't assume that this is an exemption given, because people will immediately jump and ask me a question or post me a question. Only AS 21 says when the investment in subsidiary has been made with a view of two exemptions which are happening there, which it says that where the investment is held with an investment for a short term, or it will be disposed of in the immediate future. And second one which it says is that where there is a severe long term restriction. AS 21 gives us option, 23 gives an option, 27 gives an option where consolidation is not required, whereas that exemption is not there in Ind AS 27 and Ind AS 28, Ind AS 110. So accordingly, don't jump to the conclusion that I am giving a wrong perspective, that this is exempted because it's a short-term investment. No, it's not short-term investment. Here in the facts cases, we are saying it is with a view to dispose. That means they are classifying this as held for sale in accordance with Ind AS 109, a non-current asset held for sale as a disposable group. So to that extent, it comes under 105. Okay, that's the reason why we are saying we are not going to consolidate. So based on this principle, you will get that consolidation exemption, but not as per Ind AS 110. Now, there is a possibility that the parent company reorganizes the entire group. So for example, A Limited has B Limited, C Limited, D Limited as its subsidiary, and all investments are held directly by A Limited. Now, A Limited wanted to become only an investment company in the group and not to be directly controlling this particular company. So it prepares one structure in between where it forms D Limited, which will be holding the investments in B, C. Okay, we have taken D Limited also, right? So maybe we will say entity E Limited has been newly formed between A Limited and other three subsidiaries, and that has been made as an intermediate subsidiary, intermediate parent company, and that will be holding the shares of B Limited, C Limited, and D Limited. What will happen? as a consideration for becoming the intermediate parent company, the shareholders of A Limited, ultimate parent company, will be issued shares in B Limited. So this could be a reorganization. So if it is a reorganization, two things will happen. One, if this reorganization which is happening in the structure does not have any change in the control, that means it is considered as a common control transaction. I'm using loosely that word common control transaction, but the standard uses the word before and after the reorganization. The shareholders, the control is not changing, or the shareholding pattern is not changing, or the interest of the shareholders is not changing. But nothing but A Limited still controls the entire group. So if that is the case, what is the accounting treatment? One could be the possibility. Another could be when I'm doing the restructuring, it's not reorganizing or restructuring. I am demerging one unit to totally a different entity which is acquired by outside the group. So that could also be possible. So in that case, there is a change in the control with respect to a particular investment. So let us see what this reorganization within the by a parent company within the group is happening. So what we have said is it is establishing a new entity as its parent. Could be parent has one more parent. Above that, it creates a structure. What happens? The new parent obtains, or maybe it's an intermediate parent, what I have explained in another example. The intermediate parent obtains the control of the equity instrument in exchange for the existing equity instrument. So A Limited has an equity instrument in investment, and that shares will be subscribed by B Limited, and B Limited will issue new shares to the stakeholders of A Limited. So it's a substitution in exchange for the existing equity instrument. One, by issuing that type of equity instrument, the assets and liabilities of the new group, in the new group means A, B, C, D is what is a new group. Old group, that's the assets and liabilities of the old group, that is A, B, C, D alone. So the assets and liabilities of A new group and the B group are same immediately and before the reorganization. Nothing but the control remaining the same, no change is happening. In that case, we normally do a line by line consolidation for recognizing this. What we call it as a pooling of interest method as per AS 14, when that type of business combination is happening, because it's a common control transaction. No change is happening in the control. If that is happening, the owners have same absolute and relative interest in the net assets of the original group as well as in the new group immediately before and after the reorganization. So what happens? The shareholders of A Limited previously having interest in B Limited, C Limited and D Limited, which is actually having the assets and liabilities before the reorganization. Now B Limited has came in between and it has issued shares to A Limited. That means A Limited does not have any investment in B Limited, C Limited and D Limited. It has investment only in E Limited. When E Limited comes into the picture in between, what happens is that assets and liabilities of B Limited, C Limited, D Limited, any changes happening? No changes happening. Only the structure has changed. Instead of just having A as a holding company, we also have E Limited as a holding company. Sorry, I was using sometimes B Limited as the intermediate. That is a slip of the tongue. Actually, when we are taking a structure, the new parent company, in our example, E Limited is a new parent company, but the absolute owners and their relative interest in the new group and the old group, is there any change? Absolutely no change. And if that happens, the new parent company, for its investment in the original parent, uses the same principle in the separate financial statement. What does it mean? In our example, A Limited has made an investment in subsidiary B, C, and D. So, original parent A Limited has recognized that investment in its separate financial statement. Now, A Limited is no more the parent company, and E Limited becomes the parent company. So, E Limited, the new parent, will account for the investments in accordance with in the original parent, because it has issued its shares, right? That it becomes the original parent's investment, and whatever it held as an investment in the original parent as an investment as per separate financial statement group. So nothing but same accounting treatment will continue to be done. If it has done at cost model, you can continue as a cost model. When you are doing under financial instrument standard valuation, you can use the same principle. So it is when the parent is reorganizing the group. So that means within the group. Suppose if the parent reorganizes the group and it carries investment in respect of shares in an equity instrument, the new parent, that's a new parent, should measure at cost the carrying amount of the equity shares in separate financial statement. That's what very simple. That's what we have explained. So same thing is coming here. Nothing but whatever is the cost which has been recognized by the original parent will be the cost for the new parent. This is what I'm trying to say. I thought that it is actually the other scenario. The other scenario is, suppose if it is not within the group, a new entity has been established that is not the parent. That is, in that case, the accounting treatment, that is, the assets and liabilities need not necessarily be same previously and after, right? So the control might have been changed when it is accounting for entity outside the group, a new entity as its parent company, but the common control transaction is not applicable. In that case also it says the same accounting treatment. That is, what is the new parent's carrying amount of the investment will be nothing but the carrying amount of investment of the old parent. That's a treatment. Whether the parent reorganizes within the group or outside the group, the accounting treatment says the new parent will apply the existing cost of the investments held by the old parent as its carrying amount. Let's take some example. A Limited has elected to account for its investment in subsidiary at fair value through P&L in accordance with Ind AS 109. So it has not considered cost model, it has used fair value through P&L model. As a result, it measures its investments as fair value at each reporting period. However, A Limited is unable to reliably measure its fair value in one of its subsidiaries, subsidiary B, which was set up only 1 year ago. And the investment is also not quoted in active market. So accordingly, it says, I have an option available. Does the fact that the fair value of one subsidiary cannot be measured reliably preclude A Limited from carrying its other subsidiaries at fair value in its separate financial statement? So one subsidiary is at cost, other subsidiaries at fair value through P&L. Whether it is possible is the crux of this question. And the fact says that it is not intention, but I am not able to reliably measure the fair value, and accordingly I wanted to go for a cost model. The important concept, this case study has been brought in for introducing one of the important accounting concept or measurement concept which has been brought in Ind AS 27. What Ind AS 27 says is that if an entity has elected to measure its investment in its subsidiary at fair value through P&L in accordance with Ind AS 109, all investment in subsidiary should be measured at fair value in accordance with Ind AS 109. What does it mean? The option to go for cost should be applied for all investment in my subsidiaries. Maybe for associate, I can use a different principle, 109. But within subsidiary investment, can I have cost for certain subsidiaries and fair value for certain subsidiaries as per Ind AS 109? The measurement principle says it is not possible. Either go for cost for all investment in subsidiaries or all investments at fair value as per Ind AS 109. Mixed is not possible on the assumption that you cannot measure the fair value, because Ind AS 109 says it is a rebuttable presumption that fair value can be measured for all investment, especially when it comes to equity investment. You can measure it if it is a listed entity based on active market, quoted market prices. Otherwise, you will use level 2 or level 3 inputs using some valuation technique. So it is possible to determine the fair value of the investments as per Ind AS 109, and accordingly, you cannot say it is not reliably measured because active market is not there. So what will be only possibility is that cost is not permitted. But suppose if you are concluding that the cost is approximately equivalent to the fair value, maybe it is an unlisted company, and the cost, because it's issued only within 1 year, there could not be any major business operation which might have happened. You can conclude that the cost approximates its fair value. Whatever face value is equivalent to the fair value, or whatever small profits I have made, or the intrinsic value is equivalent to the fair value. You can conclude on that basis if it is possible, unless contrary evidence is there. In that case, the cost should be applied as a deemed fair value. Again, it's not saying cost, it says it's a deemed fair value. So accordingly, unless you demonstrate that cost approximates its fair value, it's very difficult. In other words, your valuation technique should make you to at least do a fair valuation and say that that is more or less equivalent to your cost price. Otherwise, it is not possible to use cost for certain investment in subsidiaries, and for other investments in subsidiaries, you will use 109. Not possible. That's a important concept you have to consider. And what are all the major disclosures which is coming in? So you may surprise that almost we are trying to come to our uh, end of this session. Why? Because it's a simple standard. Because it only says it is applicable when you have an investment in subsidiary, associate, and joint venture. Those investments should be accounted for either at cost or as per Ind AS 109 if the option is exercised. And it naturally it has to give what has to be the accounting treatment when you have a classification and reclassification of those investments from investment in subsidiary to associate or joint venture or to financial asset. And we should also consider when the structure is reorganized within the group or outside the group. So we have seen all the accounting principle. We also said that whether mixed possibility option can be exercised on a mixed basis. That is one for cost and one for fair value. That's a simple accounting treatment. That is the reason why I started saying that the moment the standard excluded the consolidation principle, it becomes a very, very simple standard. If I'm not wrong, if my memory is correct, the standard is hardly 7 pages standard. And out of that, one page is 1 or 2 pages has been given for explaining the differences between Ind AS and AS. Um, Sorry, not Ind AS and IAS. What is the principle which we have taken? And in some cases it was talking about some of the terms. So that means hardly it is 5 to 6 pages is what is the text. Now going to the major disclosure, all the applicable standards should be used, and accordingly in preparation of the separate financial statement is the accounting principle which we have seen. So accordingly, whatever is the disclosure requirement by the separate accounting standard, each applicable accounting standard, those disclosure should be part of the separate financial statement. And of course, we also have a situation in India. If there is any disclosure required as per law, that should also be part of the disclosure, because the Companies Act requires certain prescription or certain disclosure requirement, and Schedule 3 requires certain disclosure requirement. So all of them should be provided as the disclosure in the separate financial statement. Suppose if it has applied the exemption given in Ind AS 110, that is not to consolidate, it only prepares a separate financial statement even though I am an intermediate parent company, then you have to give that fact that exemption from consolidation has been used, and at the same time, what is the name and principal business of the entity whose consolidated financial statements are available as per Ind AS. Ind ASS, that is what it's. A funny thing is comes as Ind as, it's not as. Ind accounting standards in plural have been produced for public use. We have said no. The ultimate parent company or the parent company prepares, and those consolidated financial statements are available for public use. You have to say name and the principal place of the business of the entity which has prepared the consolidated financial statement and where it is applicable for public use. So I don't have a prepared consolidation financial statement, but my parent has prepared, that is available at so and so place. That is the name of my parent company and it is available at that place, should be disclosed. And a list of significant investment in the subsidiaries, jointly controlled entities and associates, which should be what is the name of the investees and what is the principal place of business and country of incorporation of those investees if different from the parent company. Okay, so investor has a different country, and the country in which the investees there is a different country, then you have to talk about the principal place of business and the country of incorporation. Principal place of business applicable to all investments, and the country of incorporation applicable only if it is other than the parent company's country of incorporation. Actually, this is wrong because we are repeating that. It actually says that what is the percentage of investment you have on those investees. The third one, you correct it for your understanding if you are taking notes of this. What is the percentage of interest held in that subsidiary? This is again the dangerous devil of copy and paste. When I am restructuring the entire presentation to maintain a particular flow, the format which has been initially made, I have changed it. So I have made it as copy paste of the first column to the last column, but I have not changed the text. The text of the last should be what is the interest held in each of those investees should be disclosed. So what is the method of accounting which you have used with respect to the foregoing investment, whether it's a cost or whether it is as per Ind AS 109, that should also be disclosed. These are all the major disclosures. Intermediate parent company, other than which opted for an exemption in preparing the CFS, or an investor shall also identify the consolidated financial statement to which they relate in addition to the above disclosure. What does it mean? So we are only talking about what is a disclosure to be given in the separate financial statement. And we have said that where there is no consolidated financial statement, because I have applied for this, the fact of the exemption applied, and where the consolidated financial statement of the other entities in the group will be available, that we are giving. And in respect of all the investments, we are giving the details. So when I'm preparing a consolidated financial statement, so what will happen? In that scenario, the first item is not applicable. That is, the fact that I have got an exemption is not applicable, and because of the disclosure of the parent which is preparing consolidated financial statement and the place of availability of the financial statement is not applicable. But all the other things is required, where I have to say what is the significant investments made in those subsidiaries, joint ventures and associates which are consolidated, the name of those investees, the principal place of business, if the country differs from the country of the parent, the country of incorporation, and the extent of investments held in those investees should be given in the separate financial statement even if you have applied for uh, even if you have not applied for exemption from preparing a consolidated financial statement. Okay, so only that is the exemption relating to the disclosure relating to exemption will not apply, but the other disclosures will squarely apply, including how you have measured that investment, whether it's cost or as per Ind AS 109 should also be part of the separate financial statement of an entity which is decided to prepare a consolidated financial statement, as well as an intermediate parent company which has not opted for the exemption or which is not eligible for exemption. Now, we come to the last leg of our discussion. What is the difference between Ind AS as well as AS? Only one. This is preparation of a consolidated financial statement of the parent is mandatory except where exemption has been provided. But in AS, it says only when an entity prepares a consolidated financial statement, either voluntary or as per the law, then it should prepare a consolidated financial statement. Otherwise, the consolidated AS 21 is not at all applicable. So we have to see whether the preparation consolidated statement as far as Ind AS 27 is concerned, whether it is exempted or not exempted as per Ind AS 110. If it is not exempted, consolidated separate financial statement will be covered as per Ind AS 27. Consolidated financial statement will be covered as per Ind AS 110. I think that we are coming to the end of this particular standard on how an entity should prepare a separate financial statement showing its investment in subsidiaries, joint ventures, and associate. Okay, so fairly clear, simple standard. In case if you are having your questions, further questions, or you look for some additional clarifications, please post your questions and clarifications in the YouTube channel. I will answer that in the channel itself for reaching it in the wider, reaching it to the wider audience or larger audience. And uh, for the benefit of reaching this particular presentation and all our presentations which has been already made, we can request our friends to be part of our YouTube channel as a subscriber. And wherever they are asking for a link, please tell them that you can have the link of this standard. Also, go to the channel and subscribe for our channel. To that extent, you will be part of our channel and get all the updates on a regular basis. So with that, we conclude the presentation of Ind AS 27 separate financial statement, and I will come back and meet you with another standard in our Ind AS knowledge series video. Until then, goodbye. Stay safe by staying in your home.